What if I told you that doing absolutely nothing with your money could make you richer than 90% of professional investors? No stock picking, no market timing, no financial degree required, just one simple strategy that has been quietly making ordinary people wealthy for decades, and most people still do not use it. Today I am going to explain exactly what index funds are, why they work, and how you can start investing today. Even if you have never invested a single dollar in your life, stay until the end, because the last section is where most people make the biggest mistakes. Let us be honest. Most people have no idea what to do with their money. They either leave it sitting in a savings account, earning 0.5% interest, barely keeping up with inflation, or they try to pick individual stocks and lose money doing it. Here is something that might surprise you. Even professional fund managers, people with MBAs, decades of experience, and access to information you and I will never have, fail to beat the market consistently. According to S&P data, over 90% of actively managed funds underperform the S&P 500 index over a 15-year period. Let that sink in. 9 out of 10 experts with all their resources cannot consistently beat a simple index. A 2023 study found that over 20 years, less than 10% of active fund managers maintained above average returns. The evidence is overwhelming. So if the experts cannot do it, why are you trying? That is exactly where index funds come in. An index fund is simply a fund that tracks a market index. Think of it like this. Imagine you want to invest in the US economy, but you do not know which individual companies will succeed. Instead of picking one and risking being completely wrong, you buy a tiny piece of all of them. The S&P 500 is an index of the 500 largest publicly traded companies in America. APUL, Microsoft, Amazon, Google, Tesla, all of them in one single investment. When you buy an S&P 500 index fund, you are instantly diversified across 500 companies. If one company fails, it barely affects you. You are betting on the entire US economy, not one horse. This idea was actually invented by a man named Jack Bogle, who founded Vanguard back in 1975. Wall Street thought he was crazy. Why would anyone want average returns when you could try to beat the market? 50 years later, Vanguard manages over $8 trillion in assets. Turns out, average is actually extraordinary when fees are low and time is on your side. And here is the part that makes index funds even better. They are passively managed. There is no fund manager making decisions and charging you for it. That means the fees are incredibly low. A typical actively managed fund charges around 1% per year. Most S&P 500 index funds charge between 0.03% and 0.1%. That difference sounds tiny, but over 30 years, it is the difference between having $800,000 and having $1.1 million. Same investment, same market, just lower fees. Let me give you some real numbers. If you had invested $10,000 in the S&P 500 in 1993 and just left it alone, no checking, no panic selling, no touching it, by 2023, you would have roughly $210,000. No stock picking, no market timing, just patience. The S&P 500 has returned an average of around 10% per year historically. Some years it is down 30%, some years it is up 30%, but zoom out over decades and the trend is always the same direction, up. Think about the 2008 financial crisis. The market dropped nearly 50%. It felt like the end of the world. But by 2013, just 5 years later, it had fully recovered and gone on to new all-time highs. The investors who panicked and sold locked in their losses. The ones who held or even kept buying made a fortune. This is the power of compound interest. Your returns generate returns. Those returns generate more returns. It snowballs. Here is a simple example. You invest $500 per month starting at age 25. By age 65, assuming a 10% average annual return, you would have approximately $3.2 million. The same $500 per month, starting just 10 years later at age 35, you would end up with around $1.1 million. That 10-year head start is worth over $2 million. And here is the thing. You do not need to start with $500. Even $100 a month started at 25 grows to over $600,000 by retirement. Time in the market is everything. So how do you actually buy index funds? It is simpler than most people think. Step 1. Choose a brokerage. In the US, the 3 most popular options for beginners are Fidelity, Vanguard, and Charles Schwab. All 3 offer index funds with very low fees, and opening an account takes about 10 minutes online. If you are outside the US, Interactive Brokers is a great option that works in most countries worldwide. Step 2. Choose the right account type. For most beginners in the US, start with a Roth IRA. It lets your money grow completely tax-free. In 2025, you can contribute up to $7,000 per year. If you have already maxed that out, a regular taxable brokerage account is your next step. Step 3. Pick your index fund. The three most popular S&P 500 index funds are VOO from Vanguard, FXAIX from Fidelity, and SPY, the oldest and most traded. Honestly, any of these three will get you the same result. Do not overthink it. Just pick one and start. Step 4. Invest consistently. Do not wait for a market crash to buy. Do not try to time the dip. Just invest a fixed amount every single month, regardless of what the market is doing. This strategy is called dollar cost averaging. When prices are high, you buy fewer shares. When prices drop, you automatically buy more. Over time, it evens out. Set up an automatic transfer from your bank account on the first of every month. Make it boring. That is the entire strategy. Before I let you go, 3 mistakes that kill most beginners. Number 1, panic selling when the market drops. Every single time in history, the market has recovered. Number 2, waiting for the perfect time to invest. There is no perfect time. The market will always feel risky. The best time to start was yesterday. The second best time is today. Number 3, chasing individual stocks instead of staying consistent. Keep it simple. Boring wins. Index funds are not exciting. But if you start today, stay consistent, and do not touch it, they will absolutely change your financial future. If you found this useful, subscribe to Wealth Decoded. Every week we break down exactly how money works in plain English so you can build more of it. See you in the next one.